Okay. So we are discussing about the capital gains, right? So capital gains. So this is the first thing we have to know. Any profits or gains, any profits or gains arising from the transfer of capital asset, any profits or gains arising from the transfer of capital asset will be or shall be taxable under the head of capital gains. So this is what our charging section, right? Our charging section, which is 45. So this is the overview of the entire chapter. Just a sec. Yeah, this is the overview of the entire chapter. If you see, we are going to learn charging section. That means what exactly will be charged under the head of capital gains. And obviously we will now going to learn about the definition of the capital asset, and how we are going to compute, what is the format to compute the capital gains. That's we are going to learn in section 48, and exemptions. Okay, these are the things we are going to discuss in this chapter. Now I am trying to talk about section 45. So in this section 45, whatever the thing I have wrote there, right, if you see here, it is given here: any profits or gains arising from the transfer of capital asset effected in the previous year shall save as or otherwise provides in various section of section 54 or be chargeable to income tax under the head of in the head of capital gains shall be deemed to be the income of the previous year in which the transfer took place. Don't worry, I'll explain all that part now. So pretty much from there only I have written this part. So any profits or gains. So we are getting profits or gains, right? Arising. We are getting profits or gains from what? From the transfer. From the transfer of capital asset, right? Will be taxable under, and also when this transfer is happening, this also we have to know. So this transfer is happening in the previous year. Okay, yeah, this transfer is happening in the previous year. So you should be getting profits or gains arising from the transfer of capital asset. Transfer should have happened in the previous year. It will be taxable under the head of capital gains. Now the question is, what is meant by transfer and what is meant by capital gains? That's all we have to discuss it first now, right? So whenever you are transferring the capital asset in the previous year, you have to pay tax in the assessment year. Now what will be considered as a capital asset? What is called transfer. Okay, now coming back to our capital asset definition, here the capital asset definition given under section 214, 2 subsection 14. Now in this, capital asset means any kind property of any kind, because we don't want to give a definition. There are two types of definition, right? One is exhaustive definition, another one is inclusive definition, right? So we don't want to give exhaustive definition. That means this is capital asset, that's all. We don't want to give exhaustive definition. Inclusive definition, that means any kind of property will fall under capital asset. Okay, any property of any kind will fall under the capital asset. They also mentioned what exactly does not fall under the capital assets. So they mentioned what is capital asset, what is not capital asset. Okay, what is capital asset means everything, right? Pretty much everything. And they mentioned specifically, they excluded specifically some items. Apart from these items, everything is a capital asset. Okay, now if you see this one, I don't think so I need to explain this part. Fixed assets, circulating assets, that means temporary capital assets, and then movable, immovable, tangible, intangible, whether connected with business or profession. Okay, so pretty much everything, fixed, temporary, capital, tangible, intangible, movable, immovable, pretty much everything will be considered under the head of capital asset only, right? So for example, movable, shares, furniture, right? Immovable, buildings, land. Okay, tangible, like whatever we see, all tangible. Intangible, goodwill, copyrights, patents, right? So these are all property of any kind. Now specifically they mentioned these two items, which not much affected in the questions, but we'll just discuss a little bit, and then remaining, if there is anything, we're going to discuss later. Securities by FIIs, foreign institutional investors, right? That means if there is any securities held by, that means bought by the foreign institutional investors. Let's just say there is there is an institution, institution means basically the people are pooling the money, which you can learn in the capital markets, right? So they are trying to buy in India. Let's just say they are trying to buy Infosys shares. Okay, assume that there is some ABC fund. Okay, this is a foreign institutional investors. They want to invest in Infosys. They bought the Infosys shares. Okay, as per the SEBI Act, they follow all the rules and regulations, and they bought the Infosys shares. Now this will be considered as a capital asset. So whenever these guys sell these, it will be considered as a capital asset. So they has to pay tax under the head of capital gains. Okay, so the ULIP part we're going to discuss later, right? This is nothing but it's an insurance policy, right, where both shares also involved in that, and then insurance policy involved also, but right now it is not required. We will discuss a little bit later. Yeah, and one more thing, the style of our teaching will be like this. In every chapter, let's just say 70% will be required to solve the problems. Remaining 30% knowledge, we need to know it. Okay, we just need to know it. It's compulsory, we need to know it, but it is not going to test it directly in the questions. Like it may directly or indirectly helpful. This 30% is the portion. Whenever you are studying the tax, make sure you don't study line by line, page by page. It is not possible, because there are so many other chapters or other concepts involved while you are studying one concept. Let's just say you are studying section 45 itself. They will be talking about something about deductions, or they will be talking about some other chapter or some other concept which you haven't done yet. So that's why make sure you do it by questions. Okay, so if you do that, like around 70% portion will be automatically covered. So our approach is question based approach. Remaining 30% anyway we will cover at the end. Okay, and even in the exams are pretty much everywhere, these 70% portion only will be there. Okay, don't waste time like I have to read line by line, I have to complete everything given in the book. It's not possible, particularly for the tax. Okay, so do it, and also don't waste time reading the provision again and again, because no matter how many times you read, if you do questions, then only you will understand what exactly that provision is trying to explain. And also if you do many questions, you will actually understand the provision, and also you can remember it easily. Alright guys, so make sure don't just spend time just remembering, like by hearting the numbers, by hearting the dates, by hearting the rates, because in the PGBP, in capital gain salary, they'll be giving so many dates, so many rates and everything. You can remember all those things easily when you do the questions. Now, so what is capital asset? Anything, property of any kind, and then securities by FII ULIP. ULIP part we'll discuss later. Now, if you see here, this part also will come. What is excluded from the capital asset? Specifically, personal effects. That means, like let's just say I have a TV. It is a personal. Car, personal. And wearing apparel. Some people wear jewelry, like daily wearing jewelry. Again, it should not be gold jewelry, gold, silver, like the diamonds. If they are wearing a jewelry which contains gold, silver, or diamonds and all, that will be considered as a capital asset, right? It is just a normal wearing apparel, but it is not a, like which contains gold. It's not a jewelry. Jewelry means which contains gold or silver or any kind of valuable metal. Now, movable personal effects like TV, fridge, all these things. Agriculture land situated in rural area, nothing but rural agriculture land. Okay. Then stock in trade, consumable stores, and raw material held in for business or profession. See, this is important. See, stock in trade is not a capital asset if it is held for business or profession, because that will come under the PGBP, right? If it is related to the business or profession, it will come under the next chapter, PGBP. Now, if you see painting, sculptures, work of art, or drawings, if you see like Mona Lisa painting, like it costs like 10 crores, 30 crores, like that they will say, because even though you cannot say that it is a personal item, because it's a very valuable item, it will be considered as a capital asset. Archaeological collections, capital asset. Any right of management or control, capital asset. Now, how do we remember what exactly, by reading this, I'm just reading these lines, what exactly we need to remember from this? So, capital asset means any property, any kind of property. That is one thing. It is maybe tangible, intangible, movable, immovable, whatever it is. Now, what exactly exclude? This part you need to remember. So, personal effects, like jewelry, daily wear jewelry, but not gold and all those things. Okay. And personal effects and rural agriculture land. Okay. And stock in trade or raw material which are related to the business or profession. Right. So guys, do I need to waste my time on this, or do you understand like what exactly not a capital asset, whatever we discussed, this part? Tisha?
Yes, sir, understood.
Yeah, this part only. Now, also specifically we are excluding from the capital asset definition gold deposit bonds, okay, which you don't need to remember the dates and all these things, like which are notified by the CG, gold deposit bonds, and special bearer bonds 1991. So what exactly this, I don't need to explain gold deposit bonds means, right? So basically the government will issue bonds whenever the government require money, like they will issue bonds, like the gold monetization scheme. They will take the gold and then they will give the money. Anyway, these are all like very old schemes. Now we'll discuss about the special bearer bonds. Special bearer bonds 1991. Now again, there are no questions related to this, but we just have to know what is meant by special bearer bonds. If you see this part, so there is something called as Immunities and Exemptions Act. Like previously, if there is any black money held by the people, if there is any black money, if people has any black money, like they want to enter that black money into the economy. So how do they enter that into economy? We want to give some kind of route for them. Okay, so that's why we'll come up with this. No questions asked. If there is any black money, right, if you want to invest in a bonds, we will give this special bearer bonds for them. So we are going to give some exemptions to them. Okay, because we want money. If the money is in the like if the money is not in the economy, obviously it is called black money. Nobody is getting use of that. So that's why we want to encourage the people to convert that black money into white money. So we will do this special bearer bonds. And what are this and all? We don't want to spend time on this. Okay, so this is the act. This is something called as Immunities and Exemptions Act, which has no relation to our capital gains chapter. That is just to understand what is meant by special bearer bonds. Okay, these bonds are created for the government only for this purpose. Okay, but don't waste time on this. Now coming back to this. So now what is not capital asset? Personal effects and rural agriculture land, gold deposit bonds, special bearer bonds. Okay, next. But the jewelry, drawings, painting, sculptures, work of art, and any archaeological collections, these will be considered as a capital asset. All right. Now, we mentioned here rural agriculture land is not a capital asset, right? Now, what will be considered as a rural agriculture land, we should know. See, for any city, there will be municipality, right? So if you just say this is the one particular A city, right? So where this is the municipality, like these are the borders of that city. Okay, it refers if there is anything outside, this outside part will be called as rural agriculture land. See here, it refers outside jurisdiction of municipality. That means outside of the municipality, whatever the land is there outside of that municipality, outside of that city, will be considered as a rural agriculture land. So they have given some limits here. To better understand, let's see from this book. Okay, now yeah. Now if you see here, if it is a urban agriculture land, if it is a urban agriculture land, then it is a capital asset and then we will tax it. If it is a rural agriculture land, then we won't consider it as a capital asset, so we don't tax it. Now the question is, what is urban agriculture land? What is rural agriculture land? So just now we discussed, right? So if any land which is falling in this, in this municipality, in the city, that will be considered as urban agriculture land. If you read this part, the first part, agriculture land situated in any area within the jurisdiction of a municipality or cantonment board having a population of not less than 10,000. Okay, so that means this part, this particular this highlighted part, if any land is situated here, that will be considered as urban agriculture land. This part will be considered as urban agriculture land. Then what about this outside municipality? For this they have given some limits, right? So what are those limits? If you see this part, if the area, again we are talking about aerial distance. Aerial distance means we are calculating like via air. We are not calculating via earth, we are calculating via air. Now from the municipality, like again here, this is the municipality, right? This is the municipality. Then from the municipality, how much distance is there? We need to check. From the municipality, if it falls in these limits, if it falls in the limits whatever they have given, then it will be considered as a urban agriculture land, so we will tax it. So now see here, it is less than or equal to 2 kilometers, and then if the population is more than 10,000, then it will be considered as a urban agriculture land, then we will tax it. Okay, and if the population is more than 2 kilometers but less than or equal to 6 kilometers, and if it is greater than 1 lakh population, then we will consider as a capital asset. Now we'll see a question on this, so we'll get a clarity. Again, remember, if any item, if anything is falling under A or B, will be considered as a urban agriculture land. What is A? If it is falling within the jurisdiction, within the municipality, then it is urban agriculture land. Okay, then from the municipality, like within this area, if any land is falling, then again that will be considered as a capital asset, urban agriculture land. So obviously it is a capital asset. Now let's see the first question, first point. A, area A, 1 kilometer, that means from the municipality 1 kilometer is there, like from the local limits of municipality 1 kilometer is there, and in that area 9,000 people are living. Now check, is it falling under this, right? What
No,
is our
sir.
condition? Yeah, like it should be less than or equal to 2 kilometers and more than 10,000 population should be there, but here only 9,000 population is there, so it is not falling under that. So it will be, like it will be considered as rural agriculture land or urban agriculture land.
Urban agriculture.
Urban
It will
agriculture
like.
land.
Hmm.
Again, read this part. I want you to read this part. Urban agriculture land will be considered as a capital asset. Accordingly, the agriculture land described in A and B below being, that means A means this one, B is this. Accordingly, the agriculture land described in A and B below being a land situated within specified urban limits, if it is falling under the specified urban limits, would fall within the definition of capital asset, and then transfer of such land would attract the capital gains tax. Okay, if it is falling under the limits, if it is, again I'll repeat, if it is falling under the limits, it will be considered as what?
Urban
It will be considered as
agriculture.
Yeah, so if it is falling under these limits, it will be considered as urban agriculture land. See, we are not defining what is rural agriculture land, we are defining what is urban agriculture land. Apart from that, everything is rural agriculture land only. See, what is urban agriculture land? Any area which is within the municipality, like within the jurisdiction of municipality, that is urban agriculture land. Now we are talking about outside. If it is outside of the municipality, then if it is falling within these limits, then it is called urban agriculture land. If it is not falling, then it is called rural agriculture land. Am I clear now?
Yes, sir.
Yeah. Now coming back to our question, it is not falling, right?
Yes, sir.
Yes. Now, so that's why it is not a capital asset. That means it is a rural agriculture land. It is not a capital asset. Now, next another scenario. B, 1.5 kilometers and then 12,000. Again, see here, it is less than or equal to 2 kilometers and then population is more than 10,000. Okay, it is falling within the limits, right?
Yes, sir.
So can I say that this is a urban agriculture land?
Yes, sir.
So that's why it will be considered as a capital asset. Okay, next again one more thing, 2 kilometers and population is 11 lakhs. See here they mentioned less than or equal to 2 kilometers and the population should be greater than 10,000. But if it is more than 2 kilometers but less than 6 kilometers, the population should be greater than 1 lakh. Now, is it falling in the first category? Yes or no?
Yes, sir.
Because it is falling in the first category because exactly 2 kilometers also falls under the first category, right? It is less than 2 kilometers or equal to 2 kilometers, but the population should be more than 10,000. Population may be 10 lakhs or 10 crores, we don't care, right? Population should be more than 10,000. Yes, population is more than 10,000, everything is satisfied, so it will be considered as a urban agriculture land, so it will be considered as a capital asset. Next, again another scenario, 3 kilometers. Okay, then population is 80,000. Now come which scenario it is falling. That means it will come under 3 kilometers means more than 2 kilometers but less than 6 kilometers, but the population should be more than 1 lakh, but the population is here only 80,000. So it is not a urban agriculture land, that means it is a rural agriculture land, so that's why it is not a capital asset. Did you guys understand now? Now let's do
Yes.
one more. Here 4 kilometers they mention, and then population is 3 kilometers, so again it will fall under the second category, right? It will fall under the second category, so that's why it will be considered as a capital asset. It will fall under the second category. Next one, you take this one, G, 6 kilometers and the population is 8,000. 6 kilometers means it will fall under the second category, but the population should be more than 1 lakh, but here the population is only 8,000, so it won't fall under that category, so that means it is not a urban agriculture land, so it is a rural agriculture land, so it is not a capital asset. Now you understand how we read this?
Yes, sir.
So far we have discussed what is capital asset, property of any kind, and securities held by foreign institutional investors, and ULIP we did not discuss, we'll discuss later. Now what is excludes from the capital asset? What is not capital asset? Rural agriculture land, and what else?
Personal effects.
Personal effects, movable personal effects, like TV, fridge, AC, these are all movable, right? So that's why they used the word movable personal effects, and wearing apparel, that little personal jewelry people will wear, normal jewelry, right, which is not gold and all. And another one you can say gold
Deposit.
bonds, gold deposit bonds, and another one is special bearer bonds. So these things are specifically excluded. And also one more thing, stock in trade or raw material which are related to business or profession, these things are specifically excluded from the capital asset, so that means these things won't be taxed under the head of capital asset, capital gains. Okay, done this part.
Yes, sir.
Okay, next one, just a second. Okay, now so in capital asset we need to determine, is it a short term capital asset or is it a long term capital asset. So we will determine in this way. We will check 36 months, 24 months, 12 months. Okay, now if it is a 12 months, this is applicable for the listed equity shares, zero coupon bonds. See, zero coupon bonds means there is no interest rate for that. That means we will issue at par. Let's just say we will issue at 100 rupees. While redeeming, we will pay back like 120 rupees. Redeem at premium. Issue at par, redeem at premium. Of course, I'm assuming that you know what is issue and what is redeeming, and what is par and what is premium. Okay, so zero coupon bond and units of equity oriented funds, like nothing but the, let's just say mutual funds. Assume that if I am buying some mutual funds, so that mutual funds, what they will do, they will take all the public money, right? They will take all the public money, they will pool it in one place, and from there they are going to invest in the stock market. So wherever they are investing, they can invest in a debt market or they can invest in a equity market. If they are investing all the money, major money, like more than 70%, 80%, then that funds will be called as equity oriented fund. Again, this will be covered in the capital markets chapter or subject. So for all these things, if it is greater than 12 months, then it is long term, right? If it is less than 12 months, then it is short term. Okay, so if it is greater than 12 months, then it is a long term. If it is less than 12 months, it is a short term. Now again, 24 months. Again, this 24 months is applicable for immovable properties like building, land, and then unlisted equity shares. Unlisted, this is not listed in any recognized stock exchange like NSE and BSE. So then we will be considered as a we will take 24 months as the criteria. If it is more than 24 months, then it is a long term. If it is less than 24 months, then it is a short term. Then apart from these, all other assets, there are so many, all other assets we will just consider 36 months. If it is more than 36 months, long term. If it is less than 36 months, short term. Understood, guys? So 12, 24, 36. So these are the limits we will consider. Okay. So we have discussed what is capital asset. Okay, and there are these conditions, right? What are these conditions? If you want to charge the tax under the head of capital gains, the condition one, first of all, it should be capital asset. That means we have discussed what excludes the capital asset. It should not be any personal effect. It should not be stock in trade which is related to business or profession, or gold deposit bonds or special bearer bonds, right? It should not fall under any of that. And remember that specifically we will include paintings, jewelry, archaeological collection, work of art. These will be considered as a capital asset. Okay, remember that part. Now, so if it should be a capital asset, that is the condition one. And then condition two, it should be transfer. Transfer. This is defined in section 214 to subsection 14, where we are going to discuss. Wait, sorry, I think 247. Yeah, 247. That is different. Yeah, it should be a transfer. And then condition 3, it should have happened in the previous year. Okay, so year of transfer is equal to previous year. If all these three conditions are happened, then we will tax under the capital gain. So first of all, there should be a capital asset, and then that capital asset must have been transferred in what? In previous year. Of course, because of this you might be getting gains. Okay, if you are getting any profits or gains arising from the transfer of capital asset in the previous year, will be taxed under the head of capital gains. Now again, we have discussed what will be long-term capital asset, what will be short-term capital asset. This is required to find out the rates. Okay, to determine the rates. Okay, now coming back to this. So this is what they mentioned here, whatever the conditions we have discussed. So this is the condition part. Obviously there are some exceptions are there, we will discuss little bit later. Now one of the important thing in this chapter is there are some sections are there. So that sections we are going to discuss about it now. So first one is, whatever we discussed is section 45, what will be charged under the head of capital gains. Now we are going to discuss, and one more thing, this one, this also we will discuss, because this is quite theory part. they use the transfer means what? Basically it may be sale or it may be exchange. Exchange means like, let's just say I'll be giving one thing to you, like, I'll transfer one. A will transfer his building, okay, B will transfer his land. Exchange, relinquishment, that means like giving up, we are giving up his rights, okay. And then extinguishment. So pretty much these words I will explain a little bit later. And there are some other concepts also. Everything will come under the definition of transfer. This definition of transfer, again, I'm not explaining now because it won't affect directly while questions, but while doing the question, for example, this one, compulsory acquisition of asset under law. So there is a question designed for that. There we will discuss. Now, transfer means basically, if you understand this part, like, we are transferring from the property from one person to another person. Normal meaning, if you understand, that is enough for now. What is not transfer they are given, again, not required now. Yeah, this part. Section 48, how do we calculate the capital gains? See here, first of all, conditions, all conditions should be satisfied. So first of all, condition 1, there should be a capital asset. Condition 2, there should be a transfer. Again, there are specifically, they have given around maybe 17 to 18 items. What is not transfer? If it is falling under that, if they mention it is not a transfer, then we won't charge under the head of capital gains. So what is not transfer, we will discuss that part later. Now directly we will discuss how do we calculate the capital gains. So this is the format. Sale consideration, we will call this as full value consideration minus expenses on transfer, like, brokerage commission. Then you will get net sale consideration, and then cost of acquisition, that means to buy that a particular asset, how much cost you have incurred. Then cost of improvement, that means, like, let's just say you have developed that property, like, let's just say there is a building and then you have constructed one more floor, that it will be considered as a cost of improvement. Then if you do all these things, then whatever you get is the capital gains, whether it may be short term capital gains or long term capital gains. Okay, so then we'll give some exemptions. Then you will get the short term capital gains or loss, long term capital gains or loss. Now there is a difference here. The difference is here they are doing indexation for this. For example, assume that I have bought a building in 2015 for 5 lakh rupees. In 2024 I am selling that. Okay, so this is my cost of acquisition. Let's just say my sale value is 15 lakh. Minus cost of acquisition, right? How much I spent? 5 lakhs. See, if I just directly deduct only 5 lakhs, it's not fair because the time value of money is different. So the previous, like in 2015 5 lakhs, in 2024 its value is more, right? So that's why we need to convert from 2015 to 2024. This 5 lakhs, we need to adjust the inflation, we need to adjust the time value of money. So for that they have given some these numbers. Right now 5 lakhs, what is the date I have taken? 2015, right? So let's take this part 15-16. So 254. Normally we will take 100 as a base, that means 100 rupees is equal to 100 rupees when in 2001 and 2. But whereas in 2015 and 16, right, this will become 254. That means previously it was 100 rupees, now it became 254 because of the inflation. So 100 rupees converted into 254. Okay, now we are in 2023 and 24. 348. So what I'm going to do is I'm going to convert this 5 lakhs which I am in 2015. Okay, so the formula will be like this: cost of acquisition into year of transfer. Assume that I have transferred in 2023 and 24, which is 348, divided by year of acquisition. I have acquired the asset in 2015 and 16. So 5 lakhs into 254 divided by 348. So this is called indexation. We are adjusting the time value of money. Are you guys understanding? Because I'm not very sure. Tisha?
Yes, sir. Understood.
Yeah. So that's called indexation. So what is the format here? What is the format we are doing? Full value consideration minus expenses on transfer, then you will get the net sale consideration. You have to use the same format for every question. Net sale consideration, then minus cost of acquisition. If it is a long term capital asset, remember that for short term capital asset there is no indexation. Only for long term capital asset you will do the indexation. And then if there is any cost of improvement, right? If it is long term, indexation will be there. Finally you will get the long term capital gains or long term capital loss, or short term capital gain or short term capital loss. So the same format we are going to use for every question. Okay, now I know we have skipped pretty much like concept. We are not going one by one, but trust me, we are going to write one more part, and then we can directly jump into the questions. Okay, or we can directly now only start one question with one concept. So there is one concept called as conversion of capital asset into stock in trade. See, stock in trade means what? You are doing a business, right? And you have a stock in trade, right? So that stock in trade is actually related to the business, so it will go under the different head called PGBP. Now what we are doing is, I have a capital asset. Let's just say I have this furniture business. Sorry, wait, not take furniture. Let's take example building, right? I have a building, and obviously building is a capital asset. And then this building, I'm starting some real estate business. So I'm converting this building as my stock in trade, so that I can sell to my customers. So first it is my capital asset. I am converting that capital asset into stock in trade. Okay, now first we need to check. Condition 1, it is a capital asset. Condition 2, transfer. Now come to the definition of transfer. Is it a transfer or not? Right? Conversion of capital asset into stock in trade. Is it a transfer or not? Yeah, so this part. See, this is the reason why I'm not discussing all the concept at once. First I will take one part, and then I will explain that, then we'll do a question on that, then we'll keep on moving to other concepts. Like if you do like 30-40 questions, pretty much it covers all the concepts. Now see here, what did they mention? Where the asset is converted by the owner thereof into, or is treated by him as a stock in trade in a business carried by him, such conversion or treatment will be considered as a transfer. Transfer definition is given under 2 subsection 47, right? So if then it will be considered as a transfer. Transfer includes all of these things, right? So that means transfer includes conversion of capital asset into stock in trade, right? Okay, now normally there is one more thing here. Year of transfer. Okay, normally we will tax, right? If it is transferred in the previous year, you will tax in the next year, right? Assessment year, obviously. If it is transferred in the previous year, it will be taxed in the next year. Okay, but only for this conversion of capital asset into stock in trade, like year of taxability is equal to year of sale. What does that mean? Say, in our example, I have converted buildings. Building is my capital asset. In 2020 and 21, I converted these buildings into stock in trade. But this is sold in 2023 and 24. Then we will tax that under 2023 in 24 only. We don't tax in 20 and 21. That means that person has to pay whenever this building gets sold, whenever this stock in trade gets sold. Okay, so you write like this. First of all, conversion of capital into stock in trade will be considered as a, first you put a heading, and conversion of capital asset into stock in trade, it will be considered as what? Transfer under 2 subsection 47. So everything is satisfied. First, there is a capital asset is there, right? And it will be considered as a transfer. So we will tax it. Now, but when do we tax it? Only for this. Normally it will be taxed, year of taxability will be, like whenever you transfer. In the previous year, if you are transferring it, in the assessment year you have to pay tax. That is the normal rule, general rule. But only for this in the year of sale, right? So year of taxability is in the year of sale of such capital asset. Okay, now let's do a question about this. Even I think we also have okay. Now the following information is available with respect to Tina, a capital asset acquired on 1/4/2001 for 85,200. Okay, 85,200. The capital asset was converted into stock in trade on 30/9/2017. On the said date, the fair market value of the said asset was 6 lakhs. Okay, so on what date? On the conversion date. The capital asset was converted into stock in trade is 30/9/2017, right? On 30/9/2017, the fair market value is 6 lakhs. Okay, FMV is 6 lakhs. The stock in trade was sold on 15/7/2018 for 8,50,000. Determine the tax implications in the hands of Tina for the assessment year 2019 and 20. And then they have given cost inflation index, like we discussed, right? Cost inflation index, that like if it is a long term capital gains, we need to adjust to the inflation, right?
Yes, sir.
Yeah, just give me a sec. Okay, now before discussing this, I want to explain one more, just two small concept here itself, in this one itself. See, in this conversion of capital asset into stock in trade, there are two things involved. One is capital asset is converting into stock in trade. This part This is considered as a transfer under the head of capital gains chapter. It will fall under our definition. So it will come under the capital gains. Capital gains, right? Now the same thing, this stock in trade, whatever we converted, again we will be selling to our customers, right? This stock in trade is getting sold. So this we are doing under business. This is a business. So this part will come under PGBP, right? So in this transaction there are two heads involved. One is capital gain head, another one is PGBP. So in capital gains what should we tax? In PGBP what should we tax? Okay. Now since the question which whatever I have given is related to something called as cost of acquisition, so I'm going to explain one more concept also, because just quickly write this out, okay? Then whenever is required we can use this part also. See, normally the cost of acquisition, if an asset acquired before 1/4/2001, right? If an asset acquired before 1/4/2001, then fair market value on whatever is their market value on that 2001 will be considered as the cost of such asset. Normally if you are acquiring any asset before 2001, let's just say you bought an asset in 1990s or 1994, we normally take cost of acquisition is equal to like whatever the market value is there on this date, FMV on this date. Okay, there is an exception, you just write it for this. Sometimes this is rarely happens though. So cost of acquisition before 1/4/2001 or FMV on 1/4/2001, whichever is higher, right? This part I will explain you while doing the question. Okay, while doing the question I'll explain this. Now this is the only part I want you to write it. Now directly we can jump into the questions. Now here I have explained that part because of this. They mentioned capital asset acquired on 1/4/2001. What did I say? If the capital asset is acquired before 1/4/2001, we need to worry about it. If the capital asset is acquired after 1/4/2001, we don't need to worry about it. Okay. Now, so we bought it for 85,200 and then the asset is converted into stock in trade. Okay. If you do that, like I said, there are two heads involved here. Again, I will write this part. Based on this, we will gonna solve this question. What are the heads involved? One is capital gains, another one is PGBP. So in capital gains, full value consideration, FVC means full value consideration. That means nothing but sale value. Because we don't use the word sale value in the capital gains normally, because that is the value, that is the usage for PGBP, right? When you transfer, at what price we are transferring is equal to fair market value on the date of conversion. Okay. Then if there is any cost of acquisition, you can do for the index also. Index cost of acquisition into year of conversion divided by year of acquisition. In PGBP, sale value minus, guys, I can hear my voice again. Somebody please mute it. Acquisition. This acquisition is nothing but, this part. FMV on the date of conversion. Just write this. We're going to apply this on the question. Is it done?
Yes, sir.
Okay. Now, first we're gonna do about this capital gains part. Now we discussed in section 48. Guys, please mute that because I can hear my voice again. I'm not sure who is that. Divya. Okay. Yeah. So here we discussed in section 48. What did we discuss? FVC minus expenses on transfer. Then you will get net sale consideration. Okay. Net sale consideration. Then you will do any cost of acquisition and cost of improvement. Then you will get the long term capital gains or long term capital loss. Right. So the same thing we are going to discuss here. Now first part under section 48, full value consideration. What is the full value consideration under this? What did we say? FMV on the date of conversion is taken as full value consideration. Now tell me, what is the fair market value on the date of conversion when we are converting on 39/2017? The capital asset was converted into stock in trade on 39/2017. On that said date, the fair market value is 6 lakhs. So we will take that. The fair market value is equal to 6 lakhs. So fair market value will be considered as full value consideration. That full value consideration is 6 lakhs. That means when we sell to some other person, we will receive the consideration, right? That is called full value consideration. Then from that, what we will do? We're gonna deduct expenses on transfer, which they did not give anything in the question. So after that you will get net sale consideration. Net sale consideration. Now, which is 6 lakhs. Then what we're gonna do? We're gonna do index cost of acquisition. First of all, why I am doing index? Index is done only for the long-term capital asset, right? No. Is it a long-term capital asset or not?
Yes, sir. It is long-term asset.
Obviously, because we bought on 1/4/2001 and then we are transferring on 2017. Okay, it is a long-term capital asset. Okay, so obviously it is more than 36 months, so it is a long-term capital asset. So we have to do the indexation part. Okay, now indexation part. Whenever you are doing indexation, remember this formula: cost of acquisition into year of transfer. In this question, year of conversion. Like in this case, year of conversion divided by year of acquisition. That's what I have written here in this part. Right, year of conversion, because there is no transfer is not happening, conversion is happening. Conversion only we are considering as transfer, and acquisition, when did you buy it? So year of transfer into divided by year of acquisition. Okay, at what price did you acquire this stock? We acquired this stock
200.
1200 into year of transfer. When did we transfer it? Right, when did we transfer it? So we transferred, the capital asset was converted, like year of conversion. Year of transfer is nothing but year of conversion, right? So when did we convert? 39/2017. That means it will fall under which year?
2017-18.
2017 and 18. So 2017 and 18 is 272. Okay, and remember here 2001 and 2, because we have acquired this in 2001 and 2. In 2001 and 2, the index is for that 100. So 272 by 100. Just do it quickly. So we get 2317. Yes, Yes.
Two
So we're
three
gonna
one
write
seven
that.
four four.
Yes, correct. So 231744. Okay. Obviously, they did not give anything about the index of cost of improvement. Okay, this is 0. Then you will get the long term capital gains. Now 6 lakhs minus 231744.
Three six
6
eight two five
lakhs.
six.
Good. 368256. This is the long term capital gains. Very good. Now PGBP. Come to the PGBP part. So in PGBP, the stock in trade was sold on 15/7/2018. Right here, I want you to understand one thing. In 2017-18, we converted. Okay, we converted in 2017 and 18. But do we tax this in 2017 and 18 only? No. What is our rule? When you will tax it, year of tax is here, year of sale. Whenever you sell it, in that year you will tax it. Okay. So yes, you have calculated whatever we got, some 3,68,256, but you don't need to pay tax in this year. In 2017-18, you don't need to pay tax. You need to pay tax whenever it gets sold. Like whatever the capital asset you converted into stock in trade, that should get sold. It is sold for 8,50,000 on this date, on 15/7/2018. So it will fall under which year? It will fall under which year?
1819.
18-19. So the previous year is 18 and 19. So that means the stock is got sold in previous year 2018-19. So you will tax in assessment year 2019 and 20. Okay. So you cannot directly tax on 17 and 18 or 18 and 19. Right. It is normally when the transfer is happened in 17 and 18, yes, you will tax in 18 and 19 only. But in this question, you have to wait until that stock gets sold. Right. Whenever the capital asset is converted into stock in trade, you will tax only in the year of sale. Year of sale is 18 and 19. 18 and 19. Then tax will be done on the assessment year. Okay. Now see this part. We have sold it for 8,50,000. So sale value is equal to 8,50,000. What is the cost for the business? What is the cost of acquisition for the business? Cost of acquisition is nothing but whatever the FMV on the date of conversion is there, right? It's like that person is selling that capital asset to the business for 6 lakhs. Whatever the day, on the conversion date, whatever the market value is there, that will be considered as the cost of acquisition. Remaining, we will tax under the, remaining is 2,50,000, we will tax under the PGBP. Okay, guys, did you understand the entire question?
Yes, sir.
Okay, now what is the option? Which option? Read it and tell me which
D.
option.
Option D.
D. See, from this I want you to understand 3 points. One is both capital gains and PGBP is involved. That is one point. Second point is in which year, right? In which year we are taxing. For PGBP and for both capital gains, they are paying tax in assessment year 2019 and 20 only. That is one thing. And then another thing is this cost. While calculating under PGBP, the cost of acquisition is nothing but FMV on the date of conversion. Okay, so that FMV on the date of conversion is acting in two places. One is it is acting as a full value consideration, that is FVC, and it is also acting as a cost of acquisition under PGBP. Any doubt on this, or any difficulty or understanding this, or can we move on to the next one?
No doubt, sir.
No doubt. Good. The next one. Okay, see here, total in this we have this many sections in the entire normally these are called special rates of tax. Normally capital gains are special rates. Why we are calling it as special rates? You remember the basic slabs, up to 2,50,000 nil, 2,50,000 to 5 lakhs will charge 5%, 10%, 20%, all those things, right? So those are the basic slabs, normal rates. But the normal rates will not applicable for the capital gains. We will charge special rates for these people, right? So there are these sections are there. So section 111A, okay, and if it is coming under long term capital gains, we have two sections, section 112A and then section 112. Okay, section 112A and 112. See, normally for this 10%, obviously for every most of the time, sorry, it's exactly 10% is only for this, but for this, okay, normally 20%. Yes, there are some exceptions are there, we will discuss later because that is rarely tested, but we will discuss that. We have to understand that also. So 20% is here, and then this is for the short term, section 111A short term. Okay, for this is short term capital gains, we're going to charge 15%. These are the rates. Okay, understood?
Yes, sir.
Right, now if it is a long term capital gains, then we are going to give exempt up to 1 lakh, exemption up to 1 lakh. Okay, but here the one of the important sections, one of the difficult, also one of the biggest part, like most of the times in the questions they test this section 112A. Okay, so for whom section 112A is applicable? First of all, it should be a long term capital gains only. In this we have only two, section 112A, section 112. Okay, now section 112A, for whom it is applicable? If it is not section 112A, obviously it is section 112 only, because there we have only two. So first we need to know for whom and what are the conditions to apply this section 112A. Condition 1. So whatever you are transferring, right, that transfer should have happened after 1/4/2018. Okay, because this section is introduced around that time only, so that's why they kept that name, they kept that date. So if the transfer is happening 1/4/2018, and then condition 2, it should be long term capital gains only. That means basically we are talking about long term capital asset only. You can say it should be long term capital asset only. And then condition 3, it should be listed equity shares, right, and it should be either units of equity oriented fund. See, this is a mutual fund where they will invest majority in equity shares, right? For you mutual funds we will call it as units, normally it will be called as shares. Then business trust, we don't need to know the definition of business trust right now. So these things, if you are dealing with these three things, okay, then it will fall under the section 112A. So this is condition 3, and condition 4, important. There is something called as security transaction tax you have to pay, like like if your shares are listed in the recognized stock exchange, right, you can buy and sell at any point of time from your mobile, from anywhere, right? So they are giving you that facility. So for that you need to pay tax, security transaction tax. So it is paid both on buy and sell. While buying you are paying security transaction tax, while selling also you are paying security transaction tax. If these these 4 conditions satisfied, like all should satisfy, right? If all satisfy, what will happen? then section 112A is applicable, right? Section 112A applicable. This is just to test of applicability, that's it, whether it is applicable or not, right? Okay, if it is applied, then what should we do? See, obviously, how can we find out the capital gains? We already discussed the format. I sold it for, let's just say, 100 rupees. I'll call it as full value of consideration, and then I have bought this for 80. This is nothing but cost of acquisition, right? My remaining 20 rupees is capital gains. That's all. So the entire chapter lies around these two words only, like what exactly cost of acquisition, what exactly full value consideration. Keep on changing it. So here we will be focusing on cost of acquisition. Okay, now under this, assume that section 112A is applicable for you, all conditions are satisfied. Then we need to think about the cost of acquisition. This is important. Okay, what does that mean? If the securities or shares date of acquisition is before 31/1/2018, or date of acquisition, that means you bought this, date of acquisition is after 31/1/2018. Okay, if it is after 31/2018, then no problem, you take actual cost, that means how much you have spent, that much only you take, no problem, normal. But if it is before 31/1/2018, then you have to do this actual cost of acquisition. Let's just say it is 100. Okay, then second one, least of the following, FMV on 31/1/2018, okay, or FVC is nothing but full value consideration. You have to take whichever is lower. Let's just say you have to take whichever is lower. Let's just say FMV is 120, FVC is 80. You have to take whichever is lower, right? So I will take 80. Okay, then again you have to take whichever is higher, right? You have to take whichever is higher. That means this 80, this 100. I will take 100, whichever is higher. Understood, guys? So write this part. Then we're gonna do one question. I'm gonna keep on adding 2 or 3 points. First, right now, this is enough. No indexation benefit applicable. For you, if you are applying 112A, you don't need to do any indexation. If 112A applies, no indexation benefit. Okay, and then there is something called as rebate under section 87. This is covered in the basics. Rebate under section 87A is not applicable. And then no chapter 6A deductions. So you cannot claim any chapter 6A deductions. Okay, and this is one of the important. This it will make sense only when you are doing a question. Unexhausted basic exemption limit. Unexhausted basic exemption limit can be adjusted against LTCG after adjusting 1 lakh exemption limit. We know that we get 1 lakh exemption limit, right? So that one. So basic exemption limit, we know what, 2,50,000 rupees, right? That if you have any basic exemption limit unexhausted, that you can use it. This I will explain while doing the question. Now can I move on to the question, guys?
Yes, sir.
Now see this one, Jaya. Mr. Jaya or Mrs. Jaya acquires 5,000 equity shares on 1/1/2016 at 500 rupees. The fair market value of the said share on 31/1/2018 is 250. On 31/1/2018 is 600. She sells the said shares on 34/2018 at 700. Calculate the amount of long-term capital gains in the hands of Jaya, assuming that STT has been paid by on her acquisition, that means buy and sell, transfer of the said equity shares. Okay. See, first of all, whenever you are doing a capital gains question, you need to follow this. First, you need to decide whether it is a capital asset or not. Okay. Then you need to decide what is the period of holding, right? So why do we need to decide? If it is based on the period of holding, you can find out whether it is a long-term capital asset, whether it is a short-term capital asset. This is the first step, this is the second step, and the third step. Okay. Now check whether this special things, like mostly this section 112A applies or not, right? See, if it is STCA, then we will go for the 111A, no problem at all. If it is LTCA, we have two things. One is what? 112A or 112. First check 112A. If 112A is not applicable, then apply 112. That's all, right? This is the thing. First you read the question, then first find out what is the capital asset, then what is the period of holding, what section is applicable. Now in this question, what is the capital asset? What is the capital asset in this question, and what is the period of holding?
Sir, she hold a 24 month for 24-month profit. The assets.
No, capital asset is equity shares, right?
Yes, yes, yes.
In this question, capital asset is equity shares, and the period of holding, she bought on 1/1/2016, okay, and she sold on 34/2018. Okay. Now what did we discuss previously? So if it is a listed equity shares, is it a listed equity shares or not? It is a listed equity shares. If you see this part also, we need to remember, we have written, yeah, this one. So we need to check 36 or 24 or 12. So she falls under the this one because it is a listed equity shares, right? So we need to check only 12 months, not 24 months. How do I know it is a listed equity shares? That is the question again. How do I know it is a, normally they mention in the question, but here they mention STT has been paying. STT means, if they are paying STT means obviously it is a listed equity shares. Okay. Because if it is not listed in the stock exchange, you won't pay any STT. So that means it is a listed equity share. So period of holding applies only 12 months. Guys, are you following?
Yes, sir.
So it is more than 12 months or not? So what is the period of holding? Period of holding is 1/1/2016 to this date 34/2018, which is more than 12 months. Obviously it is a long term capital asset. Every question, like if you follow this format, you never go wrong. So first determine what is capital asset, then determine immediately what is the capital long term or short term. So you need to remember this 12, 24, 36. Okay. So to determine, like you need to know what falls under 12, what falls under 24, what falls under 36. Then now we have decided successfully it is a long term capital asset. Then afterwards we need to check whether section 112A is applicable or not. Okay. What is 112A conditions? Transfer, first one, transfer should have happened on after 1/4/2018. So whatever we are transferring, it should have happened after 1/4/2018. When did the transfer happen? On 30/4/2018. Condition 1 satisfied. What is condition 2? Long-term capital asset satisfied. What is condition 3? Listed equity shares or equity oriented fund, business trust satisfied. What is condition 4? STT paid both on acquisition and sell. They have given satisfied. So section 112A is applicable. This is the first thing we need to check. Then afterwards, if section 112A is applicable, then what do we need to talk about? We need to talk about the cost of acquisition. Okay. Now, before going to that cost of acquisition, let's write the format. Okay, I'll just solve here only. What is full value consideration in this question? What is the sale value? 700, right? Yeah, let's solve it here itself. So full value consideration is equal to a total 5000 shares are there into 700. Okay, see, you might have got answer like while just doing directly itself, but you follow the proper format. So in the big questions, in the tough questions, you will never go wrong. Now 5000 into 700. Okay, so you're gonna get 35 lakhs. Minus expenses on transfer, nothing is there, nil. So whatever you get, so minus expenses 0. Whatever you get, what do we call? Net sale consideration. Net sale consideration, which is nothing but 35 lakhs. Then can I do indexation for this or not? Can I do indexation for this? Tisha? Yes or no?
Yes, sir.
Actually, I can't, because if you see, just now we have written here section, if the section 112A is applicable, you cannot do any indexation. No indexation benefit is applicable if 112A applies. So that's why we cannot do any indexation. Okay, then I will take the cost of acquisition, just cost of acquisition. Now I cannot simply take whatever they have given. They mentioned that I bought at 500, and I cannot take simply this 500 because section 112A applies. Then again I need to come here, I need to check, is the date of acquisition is before 31/1/2018 or after 31/1/2018. Okay, now come back here. When did I acquire the shares? The fair market I acquired on 1/1/2016 itself. That means it is before 31/1/2018. So if it is before 31/1/2018, then we have to do this, right? This part. You have to do this part. Let's do that. Let's do that here, right? So first, actual cost of acquisition. In the question, if you see, we acquired for 500. So that is actual cost of acquisition, 500. Or what is the next one? Least of the following. Least of the following. FMV on 31/1/2018 or FVC. Okay. FMV on 31/1/2018 or FVC. Okay, FMV on 31/1/2018, it is given in the question 250. The fair market value of the said share on 31/1/2018 is 250.
Yes, sir.
Okay, just to confuse you, here they have given two numbers, 31/1/2018, 31/3/2018 they have given. Okay, so we need to take 31/1/2018. We don't care whatever it is there on the 31/3/2018. FMV on 31/1/2018, which is 250. And then FVC. FVC means at what price you sold. We know we sold at 700. So let's write that here. This is 250 and then this is 700. I need to take whichever is
Whichever is
lower. Which is lower? Yeah, 250. Then I need to take whichever is
higher.
higher. So 500 and 250. Obviously 500 is higher. Okay, so then in this question cost of acquisition will be 500. Okay, so total 5000 shares into 500. If I do that, I will get 25 lakhs. So 25 lakhs, 10 lakhs will be long term capital gains. Okay, and what did I say? If under 112A or 112, these are long term capital gain sections, and then you will get 1 lakh exemption, right? So that's why the answer is option A. So 10 lakh is the total long term capital gains which we need to tax, but out of which 9 lakh is taxable because 1 lakh rupees is exemption. And what rate we will tax? 10%. All these things we have discussed. If you see here, right, I have written the rates already, like what are the rates if section 112 and what are the rates if section 112A, right? Everything is discussed. So the make sure that you do these questions and everything is covered, every concept is covered in these questions. Okay,
Yes, sir.
now are we can we continue, or you guys are exhausted?
We can continue, sir.
We can continue. Okay, okay, so we already done one conversion of capital asset into stock in trade, right? So this question is pretty much same like that only, conversion of capital asset into stock in trade. Before that, we're gonna discuss some exemption, right? Before that, we're gonna discuss some exemption. You guys just write this part. We'll write this exemption, we'll do this question, and then we will end the class. 54 EC. This is a exemption. This is a exemption. So what does that mean? So whenever you get a long-term capital gains, right, then if you are investing in some particular bonds, then you don't need to pay tax. So what are that? So first of all, the capital asset should be land or building or both. That means whatever you are transferring, whatever the capital asset you are transferring, it should be land or building or both. And then whatever the capital gains you are getting, it must be long term capital gains. That means short term capital gains, we cannot claim this exemption. And whatever the long term capital gains you are getting, right, with that money you should buy some bonds, right? You should buy some bonds. What are those bonds? Like NHIA bonds, okay, National Highway Authority of India, or REC bonds, Rural Electric Company bonds, okay, sorry, Rural Electric Corporation bonds. So these bonds you need to buy it. If you buy these bonds, you can claim the exemption. Okay, but remember, maximum exemption can be given only 50 lakhs. It cannot be more than that. Okay, then when should I buy this? When should I buy? This is important. We need to check this every time, right? From the date of transfer, like from the date of transfer will be there, right? So from there, within 6 months you have to buy it. Within 6 months from the date of transfer, within 6 months you have to buy it. If you buy after 6 months, you cannot claim this exemption. Okay, and is there any lock-in period? Lock-in period is equal to here 5 years. 5 years. So in these 5 years, obviously you cannot sell, and obviously you cannot convert into any form. You cannot do that. Like, what does that mean? Like, obviously you cannot convert into money by pledging that, by pledging the bonds and then taking money from somewhere else. You cannot do that, or taking a loan against it. You cannot do anything. Okay, you just have to keep it 5 years. So what if you violate? Okay, if you do any violation in these 5 years, you are doing violation, then whatever exemption claimed earlier previously you might have claimed the exemption, right? That will be taxable. That will be taxable as LTCG again. So whatever the exemption we claimed, that means exemption means what? We did not tax your LTCG. Okay, but now we will tax it because you violated the conditions. So this is 54 exemption, guys. 54 EC. If you are investing in this NHIA or REC, you should do within 6 months, and then maximum exemption you can claim is 50 lakhs, and then lock-in period is 5 years. Okay, now come to this question. Harsha purchased a land at a cost of 45 lakhs in the financial year 2007 and 8, held the same as her capital asset till 31st March 2017. She started her real estate business on 1st April 2017 and converted the land, the stock in trade of her business on the said date. On that date, like on the conversion date, the fair market value is 225 lakhs. So she constructed 15 flats of equal size, quality, dimension, everything is equal. Cost of construction of each flat is 15 lakhs. Construction was completed in January 2019. She sold 10 flats of at 40 lakhs per flat, 40 lakhs per flat. The remaining 5 flats were held in stock in trade. Okay, she invested 50 lakhs in the bonds of NHIA. This is exemption part. Okay, now they are asking you to compute the capital gains and business income. Like I told you, whenever you are converting into capital asset into stock in trade, what are the points we have to discuss? We have to remember, whenever we are converting capital asset into stock in trade, what are the points? Tell me. What are the points we have to remember? Both capital gains head and PGBP head will be there. We have to tax under that. And then what else? Year of taxability will be in the year of sale, right? We will tax in the year of sale. These are the two things we need to remember now. And also FVC, fair value consideration, is FMV on the date of conversion, right? Now let's do this question. Under capital gains, FVC. What is FVC in this question? Tisha, are you there?
Yes, sir.
Yeah, what is FVC in this question? Full value consideration. FVC is equal to FMV on the date of conversion. What is the FMV on the date of conversion?
225 lakh.
Yeah, so when the fair market value of the land was 225 lakhs. So this is the FMV on the date of conversion. So 225 lakhs minus expenses on transfer. They did not give anything. So what do we get? We will get net sale consideration. This is 225 lakhs minus indexed cost of acquisition. Can I do indexation for this? Again, what is the capital asset we are dealing with? We are dealing with land. And what is the period of holding? Now, what is the how many months we need to check for the land? 12, 24, 36?
Yes, sir.
I mean, like how many months we
Long-term
need to check for the
capital.
land? Hmm?
It is long-term capital gain.
Long term capital gains only we need to check 24 months, right? Because it is a immovable property, we need to check 24 months. Obviously, it is 24 months.